Welcome to the Accumulating Wealth Podcast. I'm Judson Crawford.
And I'm Hunter Satterfield. We are CPAs, wealth advisors, and partners at CWA, a financial services firm here to help business owners navigate the decisions they face every day.
And just like that, we're back together again.
That's right. We're back after summer vacations and other family commitments. I'm excited, Judson, for us to be back in the studio together recording live.
Yeah, probably means we're in for a good current event / market update episode, huh?
That's for sure. Despite being the summer, there's still plenty going on. Let's go.
Okay, Hunter, where do you want to start today? Wait. Where you been?
Yeah, we've been around.
Yeah, been around.
We are taking, by the time this episode drops, we will have dropped Ronnie off at college. It's
insane.
Like we've been talking about this on the podcast for a year. Oh, it's a senior year. He's coming to the Accumulating Wealth seminar. He's graduating, whatever else it is. And now, here we are. We're taking him next week.
Okay. Ronnie was born in
2006.
2006. You started here in 7?
Correct. That's right.
Insane.
Employees that might be listening, some of you remember when we started a little 1-year-old wandering around, and now he's going off to college. So super exciting. We've had a great summer spending time with him as well as our other boys. But it's good to be back.
Yeah,
you too.
Agree.
I think we want to start, listeners, with a couple. One is always a fun one. And then we have a public service announcement that is incredibly important that happened to a client of ours. So we're going to go through that before doing a little bit of economy, tariff, debt talk, but most importantly, Trump accounts. We're going to talk about those today too. So tons to cover. First, Judson, I have to ask, did you go ahead and get your Mercedes-Benz?
About 3.
Because Microsoft Teams is going to be implemented now.
I want to be able just to drive around and do Teams meetings.
All the
time.
Well, Microsoft, meanwhile, yesterday came out with their top 40 jobs most likely to be affected by AI and top 40 least likely. We got to go through some of these. Mine are less fun. I'm going to do the top 40. You're going to do top or the bottom 40.
Bottom 40.
Mine are less fun. Number 1 with a 0.98 coverage, which I'm assuming is like a correlation. So it's damn near 100% likely to be impacted. This one does not surprise me. Interpreters and translators.
Nope.
No, it seems good. I mean, unfortunately, all the historians that are listening and then the passenger attendants. I don't know what that is. Sales representatives of services and writers and authors. I'm sorry, you are all in all likelihood going to lose your jobs.
I mean, I can see writers and authors of news stories, because that would be easier to accumulate. But like for like novels and stuff, I hope not.
You got to have some creativity.
You do.
There's no doubt. I mean, the positive thing, listeners, if you're listening and you are a health practitioner, not a single in the top 40, not a single health practitioner shows up at all. In fact, their CPAs didn't show up. Personal financial advisors did show up, but it's way, way, way down the list. And I would assume that's going to be like robo-advisors and things like that. But I mean, most of the ones were pretty guessable here. That's an official word. All right, you got to do some of these least 40 are hilarious.
Yeah, I think this is important for those of you out there that show up on the top 40 list, so you can kind of know what careers you can get into. My top ones that I was sort of surprised about, our clients do show up on here. Our oral surgeons were number 6, and our prosthodontists were number 11. So we definitely have some healthcare workers that have a very low chance of being taken over by AI. But those weren't really the ones that were most interesting to me. The ones that were big to me is embalmers. You're safe. And honestly, I mean, that's a pretty good career, right? AI can't take over and death ain't stopping.
That's right.
So
I mean, it's very secure.
You're in good. Here's one. Helpers - roofers. So is that not a roofer, but like the helper of the roofer?
The helper of the roofer?
Yeah.
I'm actually kind of astounded that...
Because roofers is 2 below that.
Yeah. So those are 2
So it
separate...
literally is like a helper. Maybe they just hand tiles over.
Such a give up by Microsoft. 2 of the top 40 slots for roofs.
Roustabouts.
That's on the list. You're kidding me.
No. Roustabouts, oil and gas.
Okay.
So motorboat operators, you are safe. pile driver operators safe. Yeah, so I mean, it's a list of things that you guys can look into, and also tire changers are on the list.
I love it's almost like AI put this list together. Tire changers.
Tire changers.
Number
Tire
one,
changers and roustabouts.
the least likely to be impacted is phlebotomists, which my sister-in-law is a phlebotomist, and I had no idea how to spell it until I looked at this list.
There it is.
Yeah, it does not start with an F, folks. Okay, well, anyway, speaking of moving on to an industry that is being taken over, certainly by AI, we had a client, everybody needs to listen to this. We had a client impacted by something pretty scary this week. There's all these articles out there, Wall Street Journal, Financial Times, everything that's out there is sort of warning about all this mortgage fraud. And we had a client this week that essentially they were closing, not this week, it was last week, closing on a house. And this client was in a meeting. And so he got the instructions from the title company, sent him over to his wife and was like, hey, can you call and get the wire sent out? So she calls her bank and the bank's like, hey, we think this is mortgage fraud. And she's like, wait, what? And so she shoots it back over to the husband. And he's like, all right, once my meeting's done, we'll call our realtor. So calls the realtor and the realtor's like, well, just send me the email that you got and I'll check it out. And he's like, you were on the email. He's like, no, I wasn't. Come to find out, somebody had hacked the title company, had scripted an email by changing the realtor's address by one letter, the title agent's address by one letter, put phony, fraudulent wiring instructions, and sent it to this client.
Really?
Holy cow. That's so scary. I mean, we're talking over $100,000 that could have been wired out if the bank didn't catch it. And unfortunately, this agent told this client that a client of his had been taken for $300K a couple weeks ago on this fraud. So again, listeners, you got to be super vigilant, on all things, like when you're
Everything
sending money,
financial, especially. I mean, just everything.
Yeah, any email you get, listeners, please deep dive it and make sure you're not doing something that you would regret, obviously.
So we have a mutual friend who has an agent that works for him who spent something like 20 years in the Dallas Police Department, and he was in basically the gang enforcement section. And I had a really interesting conversation with him a while back. He obviously wanted a change in career, for a lot of reasons. But what he said, in the Dallas area, one of their big gangs that they were going after 20 years ago for, mostly like drugs and things like that, was the Aryan Nation. And he's like, now they don't even want to take the risk of like selling drugs. He's like, it's all financial crimes. He's like, all of these gangs now are into, financial crimes. And so, it's not just, the overseas, what did the IRS call them? Scammers and schemers?
Yeah, always.
It's not just the ones overseas. I mean, domestically, criminals are into this significantly. So, just be careful out there, guys.
You think the Jets and Sharks have moved on from West Side Story?
I think they have.
To this?
Yeah, totally.
Yeah,
but they still dance.
Yeah, they have to, always. Yeah. All right. Well, anyway. Okay, before we move on, folks, to economy, tariffs, debt, we're doing Trump accounts, which we teased last week in our OBBBBB episode. Now hear us out on this, folks. We will have more for you as more develops here. Let me just give a quick rundown, Judson, kind of as you and I were bouncing back and forth. There are more details coming in all likelihood. Probably Q3 is when there's like a committee right now that's been put together, a federal committee that's been put together to sort of flesh out what's this actually look like. How do the websites work? How do the contributions work? How do we get these things set up and funded? But
yeah, so you cannot do this right now.
Correct. Yes. Thank you. So originally this started in the Invest America Act, which was put up by one of our Texas senators, Ted Cruz, back in May. And then it was actually wrapped into the broader One Big Beautiful bill. And that ended up getting passed. So general rules of thumb on these folks is every child under 18 is going to be eligible to have an account. Okay. So once it goes live, and I actually listened to a podcast with two of the members of the committee, and they were saying they're going to get a bunch of money raised for, not from the government, from others, to get like a push, right? To where it's like, hey, we want every kid to sign up for these things. And so there will be websites that you can sign up for. I mean, long story short, these are going to kind of be like IRAs for babies, which you and I have talked at length on the podcast, that we wish that before we had 529s and HSAs and all this, that there was just one account.
Now, I assume that this is going to be held at any financial institution.
That is being worked out right now. In all likelihood, there will be, probably like HSAs, a group of ones that come together and say, hey, we're going to sponsor these plans, because the dollar amounts are going to be on the lower side.
Yeah.
But every child under 18 will be eligible to have an account. However, only children born after the 250th anniversary of America, so July 4th of next year, only children born after that date will get the $1,000 per year from Treasury, or the $1,000 in that first year from Treasury. So let's say you have a child born, July 18th of next year.
I hope not.
Yeah, I certainly same. Then essentially what will happen is they will get an account. Once the account is set up, Treasury will actually put $1,000 into that account for that child.
And they're talking about that being a limited term for like 3 years, right?
Correct. Yeah, for right now. Which, if we've got concerns at all about the cost of this, 3.7 million babies were born in America last year that were actually like legitimate Social Security numbers, all that sort of thing. So 3.7 million times $1,000, you're talking $4 billion is going to be put into this for 1 year. The net inflows to just the Vanguard S&P 500 fund last year were 117 billion. I mean, this is a blip on the radar. And certainly I heard a stat that just the money the government gave to Afghanistan last year was 4 billion. So this is very much fundable by the Treasury, and this is not going to move markets. I think there was some concern that, oh man, this is going to move markets. No, I mean, this is a fraction of what will actually be dropped into the S&P 500 per year. So, however, even if, so I said you can open the accounts if your kids are under 18, but only if they're born after will they get the $1,000. Anybody that has an account open up until 18, family, parents, employers can gift up to $5,000 per year and receive a tax deduction for that per kiddo.
Okay, so what I saw was, and tell me if I'm wrong, because again, you listened to a much more in-depth podcast. I thought that parents or family could do 5,000, employers can do an additional 2,500, or is the cap just now? They're thinking 5,000 for everybody?
Yeah, right now it's 5,000 in addition to the 1,000 from Treasury. So there have already been, like, Michael Dell, the CEO, obviously, of Dell Technologies, has already said he's going to match for every new baby born from a Dell employee. He's going to match the $1,000 from Treasury. So I mean, there's just all kinds of really cool opportunities for companies or philanthropic organizations to contribute. Like this podcast I was listening to yesterday was basically saying, like, if some very, very wealthy Dallasite said, hey, I want to gift $1,000 to every child that has one of these accounts in this zip code that's underprivileged, they're going to have the ability to do that. So just some really neat opportunities. The focus and core aim of these is to sort of promote wealth building, this financial literacy that we talked at length, that is so there's so much of a gap in, and then also just increased economic participation. I mean, this podcast I was listening to, these guys are multi-billionaires, and they were like, so many kids that come from underprivileged areas, they don't feel like they ever have an opportunity to participate, that they never will be able to. So they just take no interest in what the S&P 500 is and how the stock market works and how the economy works. And this is a long, long, long game. But if it's a long game that creates capitalists that say, I'm going to go invest and I'm going to save for myself and I'm going to do these things, major win, right?
Yeah. No, I love the idea behind it. And I do think that it creates opportunity for, a lot of people that may not have like investing on their radar to teach their kids that this can be a way to incorporate that into, growing up. I do want to state, because I know what a lot of you guys are thinking out there is, it's not worth having a kid for the $1,000 funding. I have tried it 3 different times and they cost more than that.
I think that 1,000 gets gone real quick.
Pretty quick.
Yeah.
Yeah.
That and the child tax credit. It's just not worth it.
It's not. It's not.
As I send my kid off to college right now. So a ton of cool stuff there, folks. There's so much more coming. Again, this panel that I was listening to yesterday saying maybe by Q3, this will be fleshed out a little bit more. So stay tuned. Of course, we'll have updates for you. So we'll do a little economy talk. So Fed meeting is today. So by the time
sometime after we're done.
Yeah, that's right. I think it's broadly expectations are no rate cut. I would be really surprised if there was, but I guess we'll record on that if there is. Last odds I saw were well over 50-60% there was going to be no rate cut. So, however, GDP printed this morning. It rose 3% in Q2, which was expected in the low twos, like 2.224. So that's phenomenal. It's good to see that growth, especially because if y'all remember, as we talked about on here, Q1 was actually down 0.5%. So tremendous beat on GDP. Judson, I think it's a little hard for us to know though, right? Because we have all these tariffs.
That's correct.
We just don't know. We don't know what impact the tariffs have had on the GDP growth. What we do know is the economy seemingly is doing well.
The economy is strong. After a rough first 4 to 5 months, markets are returning. So yeah, I mean, right now things are looking good on an economic standpoint.
Yeah, I mean, this week is earnings reporting week, folks. Which if you don't pay attention to, good for you. You shouldn't, but we do here, obviously. So thus far this week, 92 stocks have reported, and 74% have beat on EPS and sales. So I mean, again, they're beating what is a prognostication by some analyst somewhere, regardless. I mean, it's good to see that it appears as though things are healthy, they're strong. Now, it's important, though, Judson, for us to state, as we always do, just because the economy appears to be strong, as far as we know, as we can see, that has nothing to do with the stock market.
That is correct.
I mean, the stock market still race higher. It could plummet. Again, we've always said the economy is not the stock market and vice versa. So we're not necessarily saying the stock market's going to rip. In fact, with the GDP beat right now, market's down today.
Yeah, waiting on the Fed.
Waiting on the Fed, indeed. So all interesting stuff. And I think we already led into this on tariffs. Judson, we broke a record in July for tariffs, right? So in July, and this is actually only through July 25th. So
just the Boston Tea Party.
A few days ago. Good point. A few days ago. Just for the month of July, $28 billion for the month. So we're going to be well over $30 billion in tariffs, which is an all-time record. And yesterday, or 2 days ago, Besson said that we're going to be at $300 billion for the year. So certainly not the $700-800 billion that was originally thrown out on Liberation Day, but we all knew that wasn't going to be the case because obviously there were pauses and he's renegotiated. I mean, heck, right now we've got a Japan and EU deal, sort of. We're still waiting on China. We're still waiting on Russia and India as well. So all kinds of other things still to be brewing. But I think that is, as the tariffs go, as economic numbers go, as the Fed goes, I think those are going to be things that drive the market the rest of this year.
100%.
Okay, last but not least, we got some buy now, pay later numbers. I mean, this debt stuff is just crazy. It's absolutely crazy. So I saw this. We're going to deep dive this buy now, pay later stuff here just for a second. I saw this, that annual transaction volume, Judson, is expected to be $120 billion in buy now, pay later. Before we go through this conversation, listeners, don't do this. Don't do this. Do not put your DoorDash or your Amazon order on buy now, pay later. But some of the stuff,
it is literally almost every time you check out online now, there is an absolute option for one of these companies that have grown so much to not pay.
Correct. Yeah. It was in 2019, it was $6 billion of transaction volume. They're expecting $120 billion just 5 years later.
It's I mean, in a way, it is loan sharking.
Yes.
I mean, it is 100%. Here's the thing that just blew my mind. It's not necessarily that there are tons of people that are using this. I mean, with the accessibility of it, there are going to be more and more people that use this type of thing. What blew my mind is that more than half, 54% of buy now, pay later users have admitted that they have been late on their loans in the past. So over half, which means that these interest and these penalties are just accumulating. So your $30 DoorDashed gummy bears are going to end up costing you $700 when all said and done.
Yeah. And if you're listening and you've not done this before and you're like, why are these guys talking about it? Just listen to these numbers. So 49% of Americans have done this already, just this year alone. That breaks down to 53% men, 46% women. So actually, maybe is a little bit more on the female side than I anticipated. Men are a bunch of knuckleheads, so I definitely, that rings true for me.
There's so many stupid toys in that right there.
Oh yeah, there's no doubt. 64% of Gen Zers have used it. That's so again, if you're a boomer, only 29% of boomers have done that. You're like, why are we even talking about this? 2/3 of Gen Zers have used these loans. So I mean, this is going to continue to be a problem, and it's just something we got to stay away from.
Well, and I think it's something. I mean, again, going back to financial literacy and everything, it's such a big thing that you should talk to your kids about and know that, hey, if they're in college and they're buying some clothing, that is very likely going to pop up as an option for them to do.
Correct. Especially that probably means, to your point a second ago, that they've already tapped out their credit card. And so now they've got their credit card where they're making interest payments at best, this loan that they're making interest payments at best. And all this data that we're giving y'all, you folks, is from Lending Tree. So these are legit numbers that are dropping. And when you couple this sort of buy now, pay later growth with a couple of these other stats, so delinquency on credit card and auto loan debts from Americans making at least $150K per year has jumped 20% in the last 2 years. So this is not just folks that are maybe on the lower income threshold. It's basically 2/3 of Gen Zers, over 50% of Americans. We've got people making $150,000 a year, 20% higher delinquency rates on credit card and auto loans as well. And so just in general, we're seeing credit card rates skyrocket. And this might be part of why the economic numbers are so strong, is that people cannot turn off the habits that were built during COVID, post-COVID, pandemic, all these different types of things.
Yep.
We might be dealing with some of that.
We're gonna, you know what? When we run for president, vice president, our motto is going to be PNOBL, pay now or buy later.
Oh, I thought it was just going to be like no PPP.
That too.
No PPP.
No PPP.
No more PTE, even though it stayed.
What was our other platform? We had a platform at one point.
Yeah.
I can't remember what it is.
It was, yeah, there have been a lot of platforms. We've never done anything with it.
Just wait. Just you guys wait.
That's right. But again, when we form these like, hey, topic of conversation, sometimes we're just scatter shooting across things, but then sometimes also things sort of formulate and come to the middle. And so we talked about the Trump accounts and how that's, sort of promoting this really positive financial literacy movement that we want. And then in the meantime, we're talking about just the cesspool that is these buy now, pay laters and how more and more people are using those. I love what you said, but like the reality is that if we're trying to create really healthy and sustainable financial plans, we absolutely need to be focusing more on the savings and less on extending our credit card debt and our other debts out. And as you're working with your own kiddos, like this one thing to say is like, hey, I'm actually reading Atomic Habits for the second time right now. And I've read The Power of Habit as well. And it's so simple, like how those little things, if your kids start now in high school and college doing the buy now, pay later, tapping credit cards and not paying them off, you are creating a monster long term. And so it's just really something to focus on, folks, as you're talking to those those in your family.
Yeah, the last section of this article from Lending Tree is how do I avoid regretting my buy now, pay later purchase? You don't even need to scroll down, guys. Just don't do it.
Does it really say that?
That is the last section.
That is amazing.
Yeah.
Stick to one loan at a time. Use a credit card if you think these are crazy. I love these articles where they actually come up with like no real actionable items. What it should say is
This is writing that's been taken away by AI.
that's right.
Right here.
Shame on it.
Yeah.
Anyway, all right, folks. As always, fun to talk to you. Get us out of here.
All right, the best way to keep up with this is to subscribe to this podcast. That way you never have to miss an episode, and you can go back and listen to all the others. Enjoying us so far? Leave us a review. It will make our day. Have a question, comment, suggestion for a future episode? We'd love to hear from you, so drop us a line at canewaters.com/wealth. We really do answer these. And if you want to learn more about what we're doing when we're not recording these episodes, visit canewaters.com to see how we're helping our over 3,200 clients reach their long-term financial goals.